What is up, everybody? Dan again, Stocktrades.ca. Welcome back to the Stocktrades YouTube channel. In this week's video, I wanted to go over Canadian CPI. The report was released on Tuesday, and although we've seen enough of a taming of inflation over the last while that eventually led to the Bank of Canada cutting interest rates by 25 basis points, this CPI report this month was largely out of line. It came in way ahead of what analysts and predictors were saying it was going to, and as a result, there's a lot of doubts that the Bank of Canada will be cutting rates again in July, something that many Canadian consumers need to happen with just the skyrocketing costs of living. So in this video, I'm going to break down the CPI report and give my thoughts. Let's go. So everybody, before we start, I apologize for not putting out a ton of videos as of late, but we were busy with the launch of our ETF Insights platform, which is now officially live. I realize I haven't put out a video yet, and although our launch is no longer active, I'm going to open up the launch discount to YouTube subscribers only. So if you head down below to the description, you're going to get a link that takes you directly to the page that will give you 33% off your first year of the platform. As we look here, we have this ETF screener that tracks over 5,200 funds. It has over 60 data points on over 5,200 funds. I mean, we can search by distributions, we can search by risk metrics, we can search by valuation, we can see the average price to earnings, price to free cash flow, expected revenue growth, earnings growth of all of the underlying holdings inside of the funds. We can click sector exposure and get, information on every single sector a particular fund has exposure to. On the left side here, we can filter by pretty much all 60 plus metrics, tax cost ratios, which are absolutely key when it comes to identifying funds with a ton of tax drag, things like that. In addition to this, we have our Q&A, which is a area where members can come in, they can ask questions on anything they see fit, whether it be even though this is ETF Insights, if you have a particular question on a stock, you can ask it, anything like that. Inside here, we have our monthly newsletter. The first issue we went over dove into high yielding funds and how a lot of them are poorly optimized, poor performing funds that tend to draw a lot of investors into them that they might not be, suitable for. Outside of that, we have ETF reports. We have these comprehensive reports on dozens of ETFs where we go over the overall objectives, the pros, the cons, the risks, the top holdings, the analysis on the top holdings. We go over competing funds, we go over distribution, and we give our overall opinion. Considering what this platform unlocks, the research it gives you, the data you have available to you with our screener, it is probably the most affordable platform in the country. So again, I'm going to open up the launch opportunity for YouTube subscribers only. I'm going to drop the link in the description, and I will keep it open for a few days. After that, I'm going to remove the link and shut it down. But let's get into the CPI report right away. So as we can see, the annual inflation rate accelerated to 2.9% in May from 2.7% a month ago. Now, most estimates were for CPI of around 2.7, 2.6%. So this is much higher than expected. And the difficulty here is the Bank of Canada was looking for inflation to continue to trend downwards. This just hasn't been the case. This was certainly a surprise report. Inflation increased on a month-over-month basis by 0.6%, whereas analysts were only expecting around 0.3% on a month-over-month basis. So if you think of a 0.6% increase, that's around 7.2% annualized, which is definitely not what the Bank of Canada wants to see right now, especially as they are going through, a downward rate cycle. And this CPI print definitely will have the Bank of Canada questioning whether or not they should continue to cut rates in July. Now, money markets are now forecasting a less than 50% chance that the Bank of Canada cuts rates in July. And before this CPI print on Tuesday morning, that was about 72-73% chance. Money markets were pricing in that percent chance of the Bank of Canada cutting rates. So this is not the optimal situation right now. So what is driving it? When we look to overall inflation, we can see that for the most part, everything is increasing at a pace that the Bank of Canada likely is not happy with. We can see here again, overall CPI came in at 2.7%. When we look to food, it's around 2.3% annualized. So food, although it did report its first increase in quite some time, I believe in a few years actually, it's close to what that annualized rate they want that annualized rate to be around 2%. So that has settled. But the one alarming thing here, and it's really not all that surprising considering Canada's mortgage structure, is shelter costs are still absolutely skyrocketing on a year-over-year basis. We're seeing 6.4% year-over-year growth in shelter costs here in Canada. This would include rents. This would include mortgages. Although rental costs are rising a little bit lower, they're still way, way too high. But the one shocking thing is mortgage costs are going up by around 22% annualized. This is way too high, and I don't really see much relief on this end of things. Even if rates do decline, they would need a material decline in interest rates to slow down this shelter increase, just because mortgages are being renewed at higher rates. People are locking in or possibly even going variable rate mortgage, coming off of those ultra low, probably sub 2% fixed rate mortgages during the pandemic. Those times are certainly over. I don't expect it to ever get back to that position again, but we're seeing, huge increases in shelter costs because of that. When we look to discretionary items, a lot of the discretionary items are actually going through a deflationary period. I mean, we see household operations, furnishings, and equipment. They're actually decreasing by 2.1% annualized. Clothing and footwear is seeing an even bigger decrease, 2.6%. But when we get into everything else, I mean, transportation, 3% boost. This is going to be probably as a result of rising fuel costs, which will pretty much impact absolutely everything when it comes to inflation. As soon as we have rising fuel costs, we have higher transportation costs, which ultimately increases the costs it takes to get goods to the store, whether that be furnishings, whether that be electronics, whether that be food. As soon as gasoline goes up, transportation costs rise, which ultimately impacts pretty much the entire economy. We see health and personal care around 3%. We see recreation, education, and reading is 1% growth. So that's actually below the Bank of Canada's, 2% target. And then when we look to alcohol, tobacco, and recreational cannabis, we see 3.4% growth. So pretty much if we go down to the table here, we can see, pretty much everything is growing ahead of the Bank of Canada's target, except for, food, most discretionary items, and possibly, recreation, education, and reading. So when we look to gasoline prices, this is going to be a big, big driver when it comes to inflation. We can look and see that, for the most part, when we head into, the latter part of 2023, we saw a lot of deflation when it comes to gasoline prices. But now we're seeing a big, big boost. In April, 7.9% year-over-year growth in gasoline prices. Now, this has to do partially with just the overall increase in the price of oil. It also has to do partially with the increase in carbon tax. There's more carbon tax being placed on gasoline now, so that is driving costs higher. But ultimately, the higher the price of oil and the more taxes that are placed on gasoline, the higher prices we're going to see at the pump and the higher everything costs. When we look to inflation by province, we're seeing some of the highest inflation yet again in Alberta. Now, this has been the case for quite some time now, and it's pretty easy to understand why this is happening. For the most part, it is due to shelter. Alberta is realizing the highest year-over-year growth in shelter costs among any province here in Canada. I'm fairly certain we're having the largest amount of interprovincial migration to Alberta, arguably in its history. I mean, the housing market here is absolutely bonkers, as a lot of people are moving away from higher priced areas and coming to Alberta because our housing costs are that much cheaper. As a result, it's putting a crazy amount of demand on the rental market, on the real estate market. I mean, in my area right now, if you list a house, it's often on and gone within a week. If you post a rental, there is often dozens of people interested in that rental. It's creating huge demand for our real estate market. We don't really have all that big a supply, and as a result, our inflation rate is, among the highest in the country. Now, if we go down to the chart here, we can see that Nova Scotia did eke out 3.1%, while Alberta is 3%. But I mean, if we look back to, March 2024, Alberta still very, very high. I'm very curious as to when this trend will slow down. As long as mortgage costs and shelter costs keep going higher and there's more demand on Alberta real estate, I don't see inflation slowing here for any time in the future. So when we look to food, just from particular types of food, we're seeing lower inflation in April on most things besides dairy and veggies. We're actually seeing deflation in a lot of fruit, bakery products, fish and seafood, meat, and, other food products are slowing down to what would be a normalized rate. So the slowdown in food inflation is definitely a positive thing, because this is one thing that impacts pretty much every Canadian. There's a lot of areas of inflation that don't necessarily impact everybody, but food is absolutely one of the areas that every single Canadian is going to be exposed to. So it is nice to see that there's some relief here. I mean, I haven't noticed rising food prices here in Alberta for quite some time. And I think where a lot of people get confused is the fact that they might see prices are still elevated. So, inflation is still red hot when it comes to food. And the important thing to distinguish here is that lower inflation is not deflation. Food prices are not going to come down at any point in the future. I mean, we're not going to see large scale deflation across food prices. What the Bank of Canada wants to do now is just try and normalize those prices and stabilize them now so they aren't out of control. And when we look to restaurants, which are struggling mightily over the last while, we can see that, food purchase from restaurants, inflation is slowing, but they're still having to keep up with the rising costs of food, the higher demand for wages, and ultimately we're still seeing around 4.3% year-over-year growth in restaurant costs, whereas food purchase from stores, grocery stores, we're only seeing around 1.4%, which is well within the Bank of Canada's target. I would expect next to no relief from restaurants over the next while. There are so many restaurants struggling right now because Canadians simply cannot afford to eat out. These restaurants, although prices are higher, they're really not making all that much more money. Actually, to be honest, most restaurants are losing money right now. Margins are way tighter because they haven't been able to, offset the increase in food prices, offset the demand from employees who want higher wages. And as a result, it's fairly hard to see, where a turnaround could be here. And I really feel for a lot of these small businesses in the restaurant industry. I believe I read a report that came out either at the end of 2023 or the start of 2024 that said that over 50% of restaurants here in Canada are actually operating at a loss. Probably a lot of them are in debt as well due to the pandemic, due to trying to get by there, and rising policy rates, higher policy rates ultimately have an impact on that too. So many of these restaurants need policy rates to come down for multiple reasons. They need them to come down so Canadians have extra disposable income to go spend at restaurants. And they also need them to come down to probably mitigate a lot of the interest costs on floating rate debt that they hold from trying to survive during the pandemic. This has been one of the toughest industries to operate in, no doubt. And I definitely feel for those in the industry. So when we look to inflation, as a whole, we can see that it is getting back to where it should be, but we certainly aren't there yet. We can see that, year over year inflation, we're down to that, near 3% mark, which is, a crazy amount lower than the, 8.1% annualized we hit in June 2022, which was an absolute disaster. Food prices were absolutely skyrocketing. Everything was skyrocketing, really. I believe I read a report that stated food is 25 to 27% more expensive today than it was in 2020. And wages haven't really gone up all that much to offset this rising cost. I mean, gasoline is up a monumental amount since then too. I don't think we ever see gasoline near $1 a liter again. But really, what does this mean for the Bank of Canada? Now, the one thing I will caution is that this is one report and one report only. This doesn't really force the Bank of Canada's hand in the fact that they can't lower interest rates because of this single bad print. The one benefit that the Bank of Canada does have is there is another CPI print coming out before it makes its rate decision in July. Now, if that report comes in, back to a more normalized level, you could see them lower rates again. If there's another jump in inflation or another, let's say, subpar print, I highly doubt they're going to be able to lower policy rates. They're probably going to go into a pretty firm hold stance. I mean, we're seeing the Bank of Canada 5-year government bond yield rise, which ultimately means, mortgage rates are probably not going to continue to go down here too until, we get a bit more clarity as to whether this was a one-off or whether this is, a period of more sticky inflation at this range, which is probably going to force their hand and not allow them to lower rates even further. So ultimately, what does this mean for the Canadian consumer? It's probably going to mean higher costs for longer. And I know tons of Canadians need relief when it comes to interest rates, when it comes to, the cost of living right now. You can argue all you want if you're not in a poor position financially that a lot of Canadians did it to themselves, but ultimately, for the Canadian economy to recover, they need lower policy rates so that Canadians can get back to having a bit of disposable income. They can get some relief when it comes to mortgage and rental costs, and ultimately it can help grow our economy further, which is really struggling right now. But yeah, it really wasn't all that good of a CPI print, but it's not the end of the world. We'll see how the one in July comes up, and we'll also pay close attention to US CPI, and we'll see what the Federal Reserve does, because the Bank of Canada doesn't want to deviate too much from what they do. Hope you found the video valuable. Head down below, smash that subscribe button, like the video, and most importantly, get your launch offer to ETF Insights below. There's a 60-day money-back guarantee attached to the subscription, so you pretty much can try it risk-free for 2 months. It's going to be one of the best platforms you've ever seen. And we'll see you next time for more great Canadian content.